Hi everyone, welcome to our accounting class. In accounting system, there are financial accounting and managerial accounting. In our videos, we only talk about financial accounting. In financial accounting system, we need to know how to record journal entries and how to post to general ledgers and trial balances, and eventually how to prepare financial statements. You may want to ask why we use financial accounting system. We use it to communicate with external decision makers, such as shareholders, investors, creditors, suppliers, and customers. How do we communicate with different parties? We use the following four basic financial statements: balance sheets, income statements, cash flow statements, and statements of shareholders' equity. These financial statements can be prepared by companies at the end of each month, which is called monthly financial statements, or at the end of each quarter, which is called quarterly financial statements, or at the end of each year, which is called annual financial statements. Here is how a balance sheet looks like. The first line here is the name of the entity or the name of the company. The second line here is the title of the statement. This one here is a balance sheet. And the third line here is the specific date. This one is prepared at March 31st, 2005. And here in bracket is the unit measure. This one is in thousands of dollars. There are three parts shown on balance sheet: assets, liabilities, and shareholders' equity. Assets are the economic resources controlled by the company which can produce future economic benefits. For example, land and building, equipment, and furniture. Liabilities are the debts or obligations of the company. For example, bank loans, loans from friends, and loans from other companies. Shareholders' equity are the financing provided by owners of the company and from earnings. For example, money that owners invested in the company. These three elements form a basic accounting equation, which is assets equals liabilities plus shareholders' equity, and we'll further discuss it in our future videos. Here is how an income statement looks like. The first line is the name of the entity or the name of the company. The second line is the title of the statement. This one is income statement. And the third line is the specific date. And this one is prepared for the year ended March 31st, 2005. And here in the bracket is the unit measure. And this one is in thousands of dollars. On income statement, there are three parts: revenues, expenses, net income or net loss. Revenues are the earnings from the sales of goods or services. For example, for McDonald's, part of their revenues are the sales of burgers. Expenses are the resources used up by the entity to earn revenues. For example, rent, labor, and utilities. For net income and net loss, we get net income when revenues are more than expenses, and we get net loss when the revenues are less than expenses. These three elements form another basic accounting equation, which is revenues less expenses equal net income or net loss. When a company earns some income, it has choices to pay dividends to shareholders or to keep it within the company, which is we call retained earnings. So here is how a statement of retained earnings looks like. The first line is the name of the entity or the name of the company. The second line is the title of the statement. This one is statement of retained earnings. The third line is the specific date. This one here is for the year ended March 31st, 2005. And here in bracket is the unit measure. Here is in thousands of dollars. As you can see, here is the return earnings at the beginning of the year. And this one is the net income earned during the year. And this one is the dividends paid during the year. And here is the return earnings at the end of the year. So the beginning balance of return earnings plus net income earned for the year minus dividends paid for the year, we get the ending balance of the return earnings. Now we'll discuss cash flow statement. Why we have a cash flow statement? Because the revenues reported do not always equal cash collected. For example, if you sell 10 burgers to a customer at $5 each, so 5 multiplied by 10 equals 50. So you earn $50, which is your revenue. And the customer said, okay, I can pay you $30 today and will pay you $20 next week. So this $30 is the cash collected. And this $20 is the cash uncollected, which is we call accounts receivable. Exactly the same thing for expenses. Expenses reported do not always equal cash paid. For example, if you buy 30 burger buns from a supplier at $1 each, so 1 multiplied 30 equal 30. So you spend $30 today. $30 is your expenses. And you say, okay, I'll pay you $20 today and we'll pay you $10 next week. So the $20 is the cash paid and the $10 is the cash unpaid, which we call accounts payable. So for a period, usually income does not equal change in cash. And this is why we have income statement and cash flow statement. So here is how a cash flow statement looks like. The first line is the name of the entity or the name of the company. The second line is the title of the statement. This one here is a cash flow statement. The third line is the specific date. This one here is for the year ended March 31st, 2005. And here in bracket is the unit measure. Here is in thousands of dollars. On cash flow statement, there are three sections: operating section, investing section, and financing section. Operating section contains cash flows directly related to earning income. For example, cash collected from customers and cash paid to suppliers. Investing section contains cash flows related to the acquisition or sale of productive assets. For example, cash received for sale of investment and cash paid to purchase equipment. Financing section contains cash flows from or to investors or creditors. For example, cash received from issuance of shares and cash paid for dividends or cash paid for debt. And the cash flow statement always ends with a reconciliation of cash. So you can see here is the net decrease in cash during the year, which is the sum of the whole thing here. And this one at the cash at the beginning of the year equals cash at end of the year. Okay, today's video is over, and these are just a basic overview of the financial statements. We'll discuss in details in our future videos, and if you have any questions or comments, please let me know. And if you like our videos, please thumb up and subscribe. Thank you very much for watching.